Welcome to the Financial Market Examiner YouTube channel, where you learn about forex, crypto, and the stock market. Well, on this channel today, we'll learn how to buy stocks. So let's get right into it. 1. Open an online brokerage account to buy stock. A brokerage account is the most convenient place to buy stocks online, but it's far from your only option. If you see yourself as an hands-on investor who likes researching companies and learning about markets, an online brokerage account is a great place to get started buying stocks. Online brokerages offer taxable accounts and tax advantage accounts. If you want to buy stocks to fund your retirement, consider an individual retirement account that offers you certain tax advantages like tax, deferred growth of your investment, and potential credits on your tax return. If you're investing for a day sooner than retirement, or you've already maxed out your retirement accounts, look to taxable brokerage accounts. While they don't offer the tax advantages of IRAs, they also don't have any limitations on how much money you can deposit or when you can withdraw funds. Your online brokerage of choice might also ask if you want to open a margin account. So with a margin account, the brokerage lends you money to buy stocks, and those let experienced investors buy more shares of stocks with less of their own money in exchange for some additional cost and much more risk. The red stock purchase plans. If you already identify stocks that you'd like to buy, you may consider a direct stock purchase plans. Not all publicly traded companies participate in direct stock purchase plans, but many of the largest, more popular names do, and you don't need a brokerage account to buy stocks this way. You most likely be charged additional fee. However, the rare purchase plans are almost always administered by third parties rather than the companies themselves. The two most common direct purchase plan administrators are Computershare and American Stock Transfer and Trust Company, commonly known as AST. Both firms charge additional fees for direct purchase plans. In contrast, most online brokers charge zero commissions to buy and sell shares of stocks. Take Coca-Cola. You can buy a one-time amount of $500 of Coca-Cola stock on Computershare for 5.00 fee, or set up at least 10 recurring $50 purchase for a $2.50 fee. Either way, there is a $0.05 processing fee for every share you buy. Reinvesting any dividends will cause a charge of 5% amount invested up to a maximum of $5. Computershare will round up your investment with fractional shares if necessary. So with the ready availability of low and no fee online brokerages, many direct purchase plans are falling out of favor. However, they may allow investors to purchase a specific company shares at a slight discount, which may help make up for the fees they charge. So you need to carefully evaluate the benefit of investing using a direct stock purchase plan before you make your first purchase. Full service brokerages. Full service brokers provide well-heeled clients with a broad variety of financial services, from retirement planning and tax preparation to estate planning. They can also help you buy stocks. The trouble is full service brokers charge steep commissions compared to online brokers. For wealthy individuals without a lot of extra time to stay on top of their complicated financial lives, full service brokers offer special treatment as well as a high level of trust if what you want to do is buy stocks. A direct purchase plan or an online brokerage is a better choice. Robo-advisors. Robo-advisors are automated investing platforms that evaluate your financial goals, investing timeline, and risk tolerance. When you sign up for a robo-investor, the platform asks you a series of questions to evaluate these factors. Then, it invests your money in a managed portfolio of exchange-traded funds tailored to your needs. The thing about robo-investors is that you're not buying stocks directly. You're buying a portfolio of funds. Some of them will almost certainly be stock funds like the SPDR S&P 500 ETF Trust, which tries to match the performance of the S&P 500 stock index. But others will likely be bond funds like Vanguard Total Bond Market ETF, which invest in fixed income securities. That doesn't make robo-advisors a bad choice for investing dollars, especially if you're more of an investor. Just keep in mind that robo-advisors may not be your first choice if you want to buy 2. Research which stock you'd like to buy. There are thousands of different companies offering shares of stocks on the market. That can make it daunting to decide which stocks to buy. One way to think about researching the stocks you want to buy is to adopt a well-thought-out strategy, like buying growth stocks or buying a portfolio of dividend stocks. Growth stocks are shares of companies that are seeing rapid, robust gains and profits or revenue. They tend to be young companies with plenty of room to grow, or companies that are serving markets with a lot of growth potentials. Owning company stocks lets you benefit from continuous strong price gains over time, although they can be highly volatile in the short term. Value stocks are shares of companies that are traded at a discount today, but may eventually increase in price as the market comes to recognize their true value. With value investing, you're looking for shares on sale with low price to earning and price to book ratios. The aim is to buy stocks that are underpriced and hold onto them over the long term. Dividend stocks pay out some of their earnings to shareholders in form of dividends. And when you buy dividend stocks, the goal is to achieve a steady stream of income from your investment, no matter whether the prices of your stream goes up or down. Dividend stocks pay out some of their earnings to shareholders in form of dividends. When you buy dividend stocks, the goal is to achieve a steady stream of income from your investment, no matter whether the price of your stocks go up or down. Certain sectors, including utilities and telecommunications, are also more likely to pay dividends. Use a stock screener to find stocks to buy. Whichever strategy you choose, a stock screener helps you narrow your list of potential stocks to buy. Stock screeners offer an endless range of filters and other tools to screen out companies that don't meet your needs. Nearly all online brokerage accounts offer stock screeners, and there are more than a few free versions available online. Check out our list of the best stock screeners for more information. With a stock screener, you can filter for small cap stocks or large cap stocks, or view a list of companies with declining shares price and stocks that are all-time highs. That lets you search your stocks by industry or market sector, featuring by PE ratio. It's a great way to find shares that are overpriced or underpriced. 3. Execute trades in your account. Once you've funded a brokerage account and identified stocks you'd like to buy, it's time to execute trades. Before you put in an order to buy stock, you need to understand a few details about the process. Purchasing stocks isn't as simple as just pressing a buy button on an app. You generally have to pick an order type, which provides instructions on how you want to purchase a stock. Two of the most common order types you have to choose from are market order and limit orders. Market order is the type of order that instructs the broker to buy stocks immediately at the lowest price available. The current stock price you see when you enter a market order isn't necessary. The price at which the market order will be executed, prices change in milliseconds, so you're only telling the broker to get the lowest price available. Limit order: you name your price and the buy only gets executed if the stock falls to that price or lower within a selected time period. If the stock never reaches a specified price before the limit order expires, the trade gets cancelled. If you have a small balance in your accounts but the share price of stocks you're looking to buy are very high, consider fractional shares. A fractional shares, you could invest as little as a few dollars in the stock. A growing number of brokers, including Charles Schwab, Fidelity, and Robinhood, to name a few, sell fractional shares. 4. Use dollar cost averaging to buy stocks over time. The trouble with stock markets is that prices fluctuate constantly. You may have your eye on a stock that looks reasonable price today, but wish to say whether the price will be higher or lower tomorrow. So dollar cost averaging provides a solution to this problem. Buy stocks with a set amount of money at regular intervals, and you may pay less per share on average over time. Crucially, dollar cost averaging allows you to get started buying stocks right away, and with a little bit of money rather than waiting to build your balance. This mitigates the risk you buy either extremely high or low, since you're spreading out your purchases across a long period of time. Let's say you use dollar cost averaging to buy your target stock at $5 a share in 1 week, $10 a share in week 2, and $9 a share in week 3. On average, you've paid $8 a share, better than if you had mistimed your purchase and gone all in at $10 a share only to see the price drop. Plus, investing the same dollar amount each time would buy you more stocks at $5 a share than at either of the other price points. Buy low and sell high is a mantra for successful stock purchasing you've probably heard more than once. But practicing this can be psychologically challenging, and it can be very, very difficult even for experts to agree what low and high are for a given stock. Automated recurring stock purchases that use dollar cost averaging help you sidestep this challenge. 5. Think carefully when to sell your stock. The ideal time to sell your stock is when you need the money. Long-term investors should have a strategy centered on financial goal and a timeline for achieving it. This means it could include a plan to start tapping your investment and using the cash you've accumulated when the time is right. That also means that deciding when you should sell a stock has very little to do with the stock or broader market are doing at the given time. Unless you're day trading and looking to turn a quick profit, which is much riskier than long-term investing, you don't even have to worry about watching day-to-day price movement. If you're second guessing whether you should hold on to a loss in stock, think again about why you bought it in the first place and decide whether anything has fundamentally changed. If not, a dip into the price might actually be a good time to buy one. Stock sales and capital gain taxes. If you decide to give your broker the sell order, be sure to understand the tax consequences first. If the stock price has gone up since when you first bought it, you may have to pay capital gains taxes. Gains on shares you owned for a year or less are subject to higher ordinary income tax rate up to 37%, depending on your income. Shares sold after more than a year get taxed to the lower term capital gain rate of 0% to 20%. If the price has gone down, you can use the loss to offset gains you may have earned elsewhere in your portfolio. For example, let's say one stock you owe fell by $10 a share. If you hold another stock that gains $15 a share, you can sell both stocks and owe taxes only on the $5 a share difference. Just watch out for the wash sale rule. Once you take advantage of the tax benefit, you cannot buy back the stock you sold at a loss or similar stock for 30 days. Kindly share your feedback on this video in the comment section. With this, we've come to the end of the video for today. Remember that this video is not for financial advice but for educational purposes only. Kindly subscribe, share and like after watching. Thank you.